Good morning, friends. Welcome to today's learning. Uh, Today's topic is final accounts. Final accounts, though it may be familiar to all the students who are from arts background, even science students are also pursuing commerce courses. This final accounts, the name itself, it is there. It is final accounts. As a part of this accounting cycle, is a last accounting activity. Initially, every financial transaction is posted into the daybook, or either we call it as journal. All the journal entries later will be posted into individual ledgers. All the balances of ledger were later posted into trial balance. Oh, with the help of a trial balance, okay, with the help of a trial balance, it becomes easy to prepare these final accounts or financial statements. Okay, let us see the meaning part. So, financial statements which are prepared at the end of the year to know about the financial position of the business are called as final accounts. Generally, every business transactions are recorded in the general book in the same day, but these final accounts are not recorded on the same day of a financial transaction. So, combination of all journal entries, ledger, trial balances, all the balances will be posted at the end of the year. At the end of the year, to see the financial position of a business, whether they are moving prospectively towards profit or whether business is moving towards losses. Final accounts gives an idea about the profitability and financial position of a business to its management, owners, and public and other interested parties. Yes, definitely. In every organization, not only owners, public is also very much interested in organizations, and all the stakeholders. So all the stakeholders who are interested in a business concern definitely will expect what the organization is performing at the end of the year, because even the investors, creditors, and bank personnel, etc., and etc., is also will be eagerly waiting how the business concerns are performing whole year. So, with the help of these final accounts, is very easy, or it brings to a conclusion that a business concern is moving profitably or whether it is getting deviated. So, as of moving further, let us see the parts of final accounts. It is trading account and profit and loss account, and lastly, balance sheet. Let us see the need and importance of final account. Is there any need? Definitely, there is a need. Preparing a final accounts, it is also very important. it is required to know the results of a business, whether it is moving profitably or losses, or to know the financial position of a business, to get loans from the financial institutions. That means if a business organization is moving prospectively, yes, its capacity is about profits is good. So even when the organizations approach for procuring loans, definitely that will be a positive from the organizations. So in order to prepare final accounts is wide because for, to meet all the financial needs of an organization, so in a multiple sources, definitely preparing a financial accounts, the final accounts is very much required. And to assess the income tax, definitely when an organization uh, earns or moves into a profit, definitely they have to calculate how much tax has to be paid to the government. So final accounts will act as an assistance for management also to, to conduct a comparative study. Definitely, year to year, organization has to move prospectively only, and profit has to be maximized every year. So until unless it is not made a comparative study from past years, then only we can't plan for future. Plans for future is based on the past activity. And coming to trading account, it tells about the gross profit and gross losses. And coming to its debit side, we can see all the direct expenses, opening stock and purchases. If you see all the direct expenses, they are specific cost directly linked to the making of a specific product or providing a specific service. For example, the flour and a sugar, the flour and sugar a bakery uses to make cakes are direct expenses. In coming to the trade side, it shows the sales and closing stock. Closing stock. Coming to profit and loss account, it tells about the net profit and net losses. The debit side of profit and loss account, it shows all indirect expenses and net loss, including all these direct expenses. If you see all administrative, selling, distribution expenses like salaries, rent, tax, postage, stationery, insurance, depreciation, etc., you can find in the debit side of P&L account or profit and loss account. Coming to the credit side, you will see all the direct incomes, means all the non-business activities such as selling of old newspapers, selling of cardboard boxes, selling fixed assets, and selling old bottles, etc. And even you will find on the trade side the gains of a uh, net gains or net profits of profit and loss account. And coming to the importance of profit and loss account, it tells about a net profitability. And even coming to the comparative study of profit and loss can be happened, and control on unnecessary expenses can take place with the help of profit and loss account. And it is also helpful in preparing balance sheet. Moving on to balance sheet, it's a statement. Know about financial position of a business on a certain fixed date. Fixed date in the sense, definitely it is end of the financial year. Till that, these balance sheets are not prepared. And moving on to the need and importance of balance sheet. Is there any need on importance of a balance sheet? Yes. I have to say yes. It tells about financial position of a firm. It tells about a liquidity position of a firm. Definitely, liquidity position is very important. The liquidity, the more the liquidity, expected liquidity of the business concern should be there. Because if all the business concerns are trying to invest more in a capital related assets, it becomes very hard. It becomes very hard to run the business smoothly. So liquidity is very important, and it tells about the balances of debtors and creditors. It tells about liabilities and assets of a firm. In also, it tells economical capability of a firm, and even open entry on the basis of balance sheet. Moving on to the similarities between trial balance and balance sheet. These both are statements. Do and why are not used in both this trial balance and balance sheet. And these are prepared from the balances of ledger. These are prepared on a specific date, no doubt. Balances of cash book written in oh. Let us see the differences between trial balance and balance sheet. Trial balance checks arithmetical accuracy, but coming to balance sheet, it shows financial position. Coming to trial balance, it gives the information about debit and credit sides. And coming to balance sheet, it shows liabilities and asset side. All accounts are written in trial balance. Only real and personal account are written in balance and prepared before trading and P&L account is about trail balance, and balance sheet is prepared after trading and P&L account. Trail balance is not compulsory, but balance sheet is compulsory. It's not a proof. Trail balance is not a proof, but balance sheet acts as a proof. Trial balance, they have no adjustments coming to balance sheet. Adjustments are considered. So let us understand what is adjustments. If any transactions omits out of the recording by the accountant, if wrongly entered in other accounts, or if amount is wrongly entered, lastly, if any transaction wrongly entered in wrong side of an account, this may also happen. So if things are moving as a human error, sometimes transactions may be omitted and that may be wrongly posted. For example, if it is 5,000, they may post as a 50,000, or if it is 50,000, they may post as a 5 lakhs. It's or they may be considered as a human errors. They may take place, but they have a chance. So they have a chance of adjusting in the balance sheets. So let us see the need and importance of adjustments. Yes, adjustments are required for balance sheet, no doubt, to find out correct profit and loss and find financial position. Yes, adjustments are required. And to rectify the errors, adjustments are also required. To complete the incomplete transactions, definitely it is required. Adjustments are required. And lastly, to record the transactions correctly or to record the current incomes and expenses, adjustments are also required. So that's all for this day, and we'll catch up again with the continuation of this concept. Till that, thank you all.